Hello, this is Chad Karnes, Chief Market Strategist at ETFguide.com. Thanks for joining me today as I take you through some charts and reasons why I think the euro has made a major top here. June 5th was a very important day for Europe. That was the day Mario Draghi pulled out all the stops and started to back up his words that he would do, and I quote, "whatever it takes to prevent the euro from continued strengthening." During the June 5th ECB meeting, Draghi lowered the deposit rate facility to an unprecedented negative 0.1%, revealed a package of targeted LTROs, which stands for longer-term refinancing operations, to the banks to the tune of around 400 billion euros, and is preparing for asset-backed security purchases in the Eurozone's version of QE. So very similar to the path the US has already taken. Usually such jawboning and wordsmithing would set off the contrarian side of my brain, just as it did temporarily as the euro traders took the euro stronger on the news, as opposed to the weakening that Draghi wanted. However, this time I think Draghi will ultimately be proven correct, that the long-term trend in the euro will resume its course to downward, and the euro's 2-year strengthening ended back in May. To me, it looks like all downside on the euro from here on out. So first, let's look at a chart. This chart shows the euro's history since its virtual formation in 1999, and shows that its weakest point was shortly after that formation in the year 2000 and 2001, when it was trading in the 80s. So what this means is that if you gave 80 US dollars cents, you would get 1 euro. It strengthened significantly into 2008 as shown in blue, but since has been declining in trend, making lower highs and lower lows shown in red. In 2008, the euro hit as high as 1.6. So in 2008 it cost $1.60 US to get 1 euro. Today the euro trades around 1.35, so today it costs about $1.35 US to get 1 euro. Now check out the next chart, which I provided to our subscribers in early June, showing why further weakness in the euro would be very bad technically for the euro. I also included this chart in a previous article that can be found on our homepage, ETFguide.com, from June 12th, entitled, "Did Draghi Just Put the Dagger in the Euro Rally?" From the 2012 low, all the euro has done is bounce into typical counter-trend resistance levels, as it once again bumped into a key trend line this late spring, early summer. It then struggled multiple times to exceed the 140 level, and 140 has actually never been exceeded since back in 2011. To me, this shows that the euro bounce since 2012 was just a normal counter-trend correction into resistance. So there's two things going on technically here, one very long-term and one intermediate term, but both equally important. The red lines are what's called in technical analysis Fibonacci retracement levels. And what these levels do is they measure what a typical counter-trend move retraces. So the original move was here from 2011 to 2012, from 150 down to around 120. And since then, all the euro has done is rallied back up into this normal typical retracement level, where it also met the very long term, shown in blue, down trend line and trend channel resistance level. And you can see perfectly how this resistance level rejected prices around just below 140 in May and June. In addition, price formed a key trend line from the 2012 low that would help show when momentum warned of a trend change on the euro on a shorter term basis. Price tested this upside momentum line during Draghi's June 5th ECB meeting, shown in this next chart by the green trend line, so right here. So I've drawn, this is just another zoomed in version of the previous chart from the 2012 low here on a weekly basis, and you can see this green trend line that connects the low of 2012 with the low of 2013, and also with a low, the Draghi low of 2014. From there, the chart also reveals it best, and I'll zoom in here so we can see a little better. The trend line remains support. So right here, this candle is what's called a hammer candle, and this is a weekly hammer candle, and this is the week that Draghi spoke of June 5th, and this is a bullish candle on a short-term basis, and we can see that price came down, tested this trend line, and then rallied, which is a bullish short-term setup, and that trend line held for the following month. But now check out the final chart, which is a daily chart and shows a zoomed in version of what's happened since the May top. The euro fell below this Draghi low. So here is the Draghi low now on a daily basis, and you can see it's also a really big candle and very easy to identify. And then you can see that since June 5th, all of the price action had pretty much been encompassed within this range into last week in July, when 1.350 broke down. Euro buyers did not step up to the plate, and they only managed to take price above the Draghi levels for 2 days right here, which also tested this parallel trend channel resistance and a similar Fibonacci retracement level, 38.2%, as shown earlier in the longer term chart in red. The similar thing occurred on a shorter term basis, setting up a very similar sell signal on the short term basis as well. So they had their chance to step up. They couldn't get back above the Draghi high, and then since price has fallen below that Draghi low, and I think that has now put the dagger in the euro rally, and I think that this May top right here, from a long-term and a short-term basis, will be a major euro top, and I think that we can be selling the euro, as I've suggested to my subscribers over the last few weeks, selling a breakdown of 135. And you can see already what has occurred in the last just 4 days. We've already almost made a whole point on that short trade of the euro. You know, this doesn't mean there won't be short-term bounces, but what it does mean to me is shows that any bounces likely will be sold into this Draghi level. I mean, this level between 135 and 136 is now extremely important on the euro. The bulls tried to step up, they couldn't do it, and now they've all become sellers. Any bounces into this area will likely be sold by previous owners looking to break even, or new money entering to sell the euro short. This also has implications for the US dollar, which I discussed in our March ETF Profit Strategy newsletter when in a title, Do Dollar Bears Have It Right? And I included this chart, which is a very long-term chart of the dollar, and you can see just starting on this right side, the dollar has started to rally a little, and once I see it break above this, what looks to me as a long-term inverted head and shoulders pattern, which is just a very long-term basing pattern, forming a base, and that would constitute a breakout where the dollar could get much higher through the end of 2014 and into 2015. This chart on the screen, you know, we provided this to our subscribers back in March, and I've been waiting patiently for this trend line to break. And if it does, I think it'll also have very big implications, which I talked about in that article as well, for precious metals. So a declining euro means the dollar will likely rally, which also will have an effect on precious metals. Thanks for joining me today, and please check out some of our other videos at ETFguide.com. We're also on Twitter, and we offer a monthly newsletter, weekly ETF picks, and I do a twice weekly technical forecast. Thanks again.